Welcome back to Investing Talk podcast. You sent in some fascinating stuff on semiconductor. I mean, financials, market analysis, all kinds of reports. And
Yeah.
it's our job to break it down for you to see what's really going on with this company right now. So just to get us started, we have their Q4 and full year 2024 numbers.
Okay.
1.72 billion and 7.1 billion in revenue, respectively. We also have these predictions of a 15 to 17% revenue drop coming up in 2025. Q4 2024 EPS landed at 95 cents, and there's a debt-to-equity ratio hovering around 38%. We also have insights into their strategic direction, how their stock's been doing, which is down a significant 37.26% just this year. And to top it all off, we have the bigger picture of the semiconductor industry to consider.
Lots to dig into.
Right, so much to unpack, so let's get started.
Let's do it.
So right off the bat, we see this huge contrast with the 2024 revenue numbers, which were super strong. 7.1 billion for the full year, 1.72 billion for just the last quarter of 2024. That signals a recent period of real strength.
It does.
But then we have this looming 15 to 17% revenue decline predicted for 2025. It makes you wonder what's driving that.
Right. I think it clearly highlights the current weaker demand we're seeing, particularly in the automotive and industrial sectors,
Right.
which are pretty key to Auto and Semiconductor's business.
Absolutely, they are. So we're definitely seeing this picture of a company hitting some major headwinds after a strong run. And this anticipated revenue drop for this year is hard to ignore. And we see that reflected in their per-share earnings, too.
Yeah.
They reported 95 cents for Q4 of last year. But the outlook for EPS is weaker moving forward. So what's going on there beyond just less revenue?
Well, if we zoom out a bit and look at the bigger picture, the anticipated EPS weakness isn't just about the lower revenue. It's also tied to expectations of what we call margin compression.
Okay.
When demand softens, businesses often struggle to hold on to their desired price points. There's also the restructuring plan to consider, which is designed to cut costs. But it's likely to involve some upfront spending that could further impact their bottom line in the short term.
Yeah, that makes sense.
But it's a good sign that they're planning to maintain solid free cash flow through this period by carefully managing inventory and reducing costs.
It sounds like they're actively trying to manage those expenses in response to these shifts in the market. So let's move beyond the financials for a bit. It seems like their core strategy is really rooted in these high-growth, high-margin areas within automotive and industrial. Automotive alone was a whopping 60% of their revenue in 2024.
That's huge.
What exactly gives them an edge in these markets?
Their focus on these particular sectors is certainly a key part of their strategy. But what I find really interesting is their very targeted approach within automotive, like zeroing in on electric vehicles and image sensors. And they're doing something similar in the industrial space, too, focusing on areas with a lot of potential. The data also points to structural improvements made since 2020, which seem to have set them up for good profitability down the line. It suggests they've been really fine-tuning their operations, strategically focusing their research and development efforts,
Makes sense.
which seems to be paying off even with this current slowdown.
That's great to hear.
Their investments in silicon carbide technology are also crucial here. This is a next-generation material with some major advantages in power electronics, especially for EVs.
And silicon carbide seems to be a major innovation area across the whole industry right now. And they've just launched a new 1200-volt silicon carbide MOSFET specifically for the industrial sector. That seems like a very concrete step in leveraging that technology. And it's encouraging to see that they're continuing to innovate even amidst these current challenges.
Yeah, it is.
So how does all of this compare to the wider trends we're seeing in the semiconductor industry as a whole?
So if we look at the bigger picture, the semiconductor industry is actually expected to grow in 2025.
Okay.
A lot of that is being driven by the demand for AI and data center chips. But, the reports do indicate some potential challenges in the automotive and traditional computing segments,
Right.
which aligns with ON Semiconductor's projected revenue decline, given how heavily they rely on automotive.
Right.
They're a major player in their chosen areas. But they are up against some big established companies like Texas Instruments, ST Microelectronics, Toshiba Broadcom. Their real strength seems to be in those very specific automotive and industrial solutions,
Yeah.
which helps them stand out from competitors who have more diversified product ranges.
It's like they're focusing on what they're really good at, even if those markets are a bit shaky right now.
Exactly.
And then there's this news about a almost 15% year-over-year revenue decrease in Q4 2024, and their adjusted EPS missed expectations. That's a pretty big drop. They've also announced a 9% workforce reduction as part of a restructuring. So, what's the rationale behind these decisions, and what impact might we see?
I think this brings up a really fundamental question about how companies adapt when demand goes down. This almost 15% revenue decline and the EPS miss it. Those are clear signs of a pretty significant softening in their main markets. The restructuring plan, including that 9% workforce reduction, it's a direct response to that. It's about lowering costs and improving efficiency in the face of lower revenue. While these moves can help boost profitability during a downturn, they're not without risks. Like, you have potential impacts on employee morale and maybe losing some key talent.
Yeah, those are definitely things to consider.
But the fact that they're taking these proactive steps to manage their costs, it does suggest that they're focused on weathering this storm and preparing for when demand picks back up.
And that significant drop in their stock price this year, over 37% just so far.
Wow.
That definitely reflects some of this uncertainty. It looks like the disappointing earnings and that weak forecast for the first quarter of 2025 have really shaken investor confidence. So beyond just the financials and the industry trends, the reports highlight a few major risks: weak demand inventory adjustments and global macroeconomic uncertainties. How interconnected are those factors?
Well, they're actually very deeply intertwined. Weak demand, especially in their core markets, automotive and industrial, it directly translates to lower sales, which of course impacts revenue.
Right.
And this weak demand can also lead to those inventory adjustments, where companies find themselves with too much stock on hand. And that can lead to price cuts, which puts even more pressure on profit margins. And then sort of underpinning all of this are those global macroeconomic uncertainties. Inflation, interest rate hikes, concerns about economic growth, all of that. It can really influence how much consumers and businesses are willing to spend.
Yeah.
And that directly affects the demand for semiconductors.
Right.
And on semiconductors, heavy reliance on the automotive sector makes them particularly vulnerable to any downturns or just shifts in that specific market.
And we can't forget about the geopolitical risks either. The potential impact of the tension, especially between the U.S. and China, on the semiconductor supply chain, that's a constant concern for the entire industry. It likely adds another layer of risk for ON Semiconductor as well. Now, despite these challenges, analysts seem to see some potential for growth. There's a consensus price target that suggests a rather big increase. How do we reconcile that with all these headwinds?
This really highlights how forward-looking market analysis can be. While the immediate challenges are definitely real, and they're reflected in the stock's recent performance, that consensus price target probably reflects the anticipated long-term growth potential.
Okay.
Especially in those key areas like silicon carbide technology and the automotive and industrial sectors. Analysts may be predicting a rebound in these markets and believe ON Semiconductor's strategic focus, and their investments will put them in a good position to capitalize on that recovery. But the cautious sentiment among analysts, particularly about the electric vehicle sector, it suggests that there are still some big uncertainties. And that potential upside isn't a sure thing. It's really a balancing act between the current difficulties and the anticipated future opportunities.
So it sounds like it's a bit of a mixed bag. We have these short-term challenges and restructuring efforts, but there's also this strategic emphasis on areas that could drive future growth. The recommendation leaning towards a hold for current investors that acknowledges those current risks, but a buy for new investors who are more optimistic about automotive and industrial growth suggests that the long-term potential might outweigh the current difficulties, for those with a higher risk tolerance, of course. It's also interesting that the company is committed to achieving net zero emissions by 2040. That's a long way off, but it could definitely appeal to environmentally conscious investors.
It adds another layer to their overall profile. This commitment to sustainability aligns with its growing interest among investors. In environmental, social, and governance factors, it might not be the main driver of their immediate stock performance, but it could definitely contribute to their long-term appeal and their brand reputation.
So taking all of these pieces into account, you can see a company navigating a tough time. But they have a clear strategic focus on long-term growth areas. The expected revenue decline and the restructuring efforts, those highlight the current challenges. But their investments in silicon carbide and their strong position in automotive and industrial markets, those suggest potential for a future rebound. What stands out to you the most from this overview?
Well, what really strikes me is this delicate balance they need to maintain between making these immediate cost cuts and continuing to invest in future technologies like silicon carbide.
Right.
It raises the question of whether these restructuring efforts will actually hinder their innovation pipeline Can they maintain their competitive advantage, even with this current market weakness? These are crucial factors to keep an eye on as the year progresses.
We hope this overview has given you a clearer understanding of the key aspects of Anand Semiconductor right now. Don't forget to subscribe, like, and comment. And let us know what other companies or topics you'd like us to explore in our next analysis.